Hello, I'm Daphne Wilson, and welcome to my channel where I talk about how to earn passive income in real estate by being the bank and not the landlord. In this video, I'm going to talk about how to determine how much you should pay for a mortgage note, specifically a non-performing second mortgage note. So, if this is your first time on my channel, I want to say welcome. Feel free to look at the other content that is available on the channel. There's a lot of really useful information. Don't forget to like and subscribe and post a comment. If you have a question about anything that I have to say today, please leave that question in the comments and I will answer it as soon as I get a chance. Okay? So let's jump right into it. How much should you pay for a mortgage note, a non-performing second mortgage note? And I get asked that question a lot. The first thing to know is that pricing is based on the unpaid principal balance. That is the amount that the homeowner has left to pay off the loan. Okay, so the unpaid principal balance is the amount remaining that is not paid off. And that is what the basis of your pricing is going to be. So if a mortgage note is the balance is $50,000. That's what's remaining before that loan is paid off. The price of that mortgage will be different from a mortgage where the unpaid principal balance is maybe only $10,000. Okay, so the amount that is remaining outstanding is the basis on your pricing. And then from there, you want to look at some other important factors. The first one being the status of the first mortgage. When you're buying a delinquent or distressed second mortgage, it's important to find out what the status of that first mortgage is. And of course, a first mortgage being paid and current is the best case scenario. Because if a homeowner is not paying their first mortgage, you're probably not going to be able to get them to pay the second mortgage. Okay. So, and that's what you want. You want them to start paying on your second mortgage. So if they're current on the first, that lets you know that the homeowner is interested in staying in the home because they're keeping up with that first mortgage. So right out the gate, you are looking at the unpaid principal balance and you're looking at the status of the first mortgage. All right, so those are the two things. The next thing you want to look at is the equity position of the property. That's very important as well, especially when you're buying a distressed second mortgage, because the um, equity position is what will protect you in the event that the homeowner stops paying the first mortgage, okay, which could possibly happen if a person loses their job or receives a diagnosis and, sick in the hospital or whatever, particularly the breadwinner, right? Um, so that equity position will protect you in the event that the homeowner stops paying the first mortgage or they file bankruptcy. Okay, so if the homeowner files bankruptcy and there is equity above that first mortgage, then that increases substantially the likelihood that you will continue to get paid on that mortgage note. All right. So what I mean by equity position above the first, meaning that if a homeowner has a mortgage that they only owe $100,000 remaining on the mortgage, and the property is worth 300,000, then they have $200,000 in equity. All right. Maybe you have a $50,000 second mortgage. Well, there's plenty of equity above the first mortgage to cover your $50,000 second. So if the homeowner, for whatever reason, were to stop paying the first mortgage or they file bankruptcy, then the likelihood is very high that you are still going to be able to get paid. So, for example, if the homeowner files, if the first mortgage files foreclosure, okay, and there's $200,000 in equity in the property, when that home goes to foreclosure sale, the proceeds of the sale will first be divvied up to pay off the first mortgage, and then the remaining funds will go towards paying off the second mortgage. Okay, if you don't have equity above the first mortgage, then it's very possible that during the foreclosure sale, you will not get paid. So that equity buffer is very important. So if you have if you're basing your price off of the unpaid principal balance, the first mortgage is current, and there's equity above the first mortgage, then you're looking at a very, very favorable position on that loan. So then one of the things that you're going to need to decide, and this is uh, based off of your own amount of capital that you have available to buy this mortgage note, as well as what the market will bear. So if you look at loans that are on the market and you see what they're going for, or you're buying directly from banks, hedge funds, credit unions, and things like that, where the pricing is going to be much lower, then you can make a determination on, okay, um, for a mortgage note, a distressed second mortgage note, I want to start out at 40% of the unpaid principal balance. That is your baseline. Okay, and this is an example. That's your baseline. There's no hardcore way of determining the price, but you want to make sure that the value is there. So say you say, okay, I'm going to start out if the mortgage, the status of the first mortgage is current and it's never been late, and there's a significant amount of equity above the first mortgage. You can determine what that is, whether that's $50,000, $100,000 of equity above that mortgage. Then you may say, okay, under these conditions, I am prepared to offer 40% of the unpaid principal balance to purchase this mortgage note. Okay, so you establish a baseline for yourself. From there, you want to factor in other characteristics. Okay, and that may be whether the property is in a judicial or non-judicial state, meaning that in the event of a foreclosure, um, a judicial state is going to require that you go through the court system in order to do a foreclosure. In a non-judicial state, you do not have to go through the court process. You could probably just use an attorney. Okay. And the difference there, particularly for non-performing seconds, since it is rare that there's a foreclosure and you take over the property with a distressed second, what it does for you is if you are in a if the property is in a non-judicial state, you are able to use foreclosure as leverage to bring the borrower to the table to work out the loan. So, for example, in the state of Georgia, Georgia is a non-judicial state. So, a lender or investor can foreclose on a homeowner pretty quickly. Okay, we're talking, 30, 60 days, 90 days. Okay, it's a pretty quick process. Actually, it's probably more like 60 days. And what that does is it puts a lot of pressure on that homeowner to say, okay, I need to come up with something pretty quickly. I need to reach out to this lender and work out a payment option. Okay. Now, if you are in a judicial state where you have to go through a court process, well, that process could take much longer. Okay. It could take 6 months, a year, or maybe longer, depending on the circumstances. So, with that, you can certainly still use foreclosure or the threat of foreclosure to bring the homeowner to the table. However, the homeowner may very well be aware, either themselves or through legal counsel advice, that the process could take a while and that they have a while to resolve it before it gets to the point of foreclosure. Okay, so it may not be as quick to be able to work out that loan with the homeowner if you are in a judicial state. So that could factor in to the price that you're willing to pay. Okay. Another thing is the actual paper itself. All right. So since we're buying paper instead of property, we want to make sure that the paper is original. That means you want the original mortgage or deed of trust that was signed at the closing. You also want the original promissory note, the note. Okay. Those two things are very important because we are buying the mortgage, and so we want to make sure that we're buying the original mortgage. All right. So you're going to want the mortgage and the note to both be originals and not copies. All right. Another thing that's important is the chain of title. If a mortgage has changed hands multiple times throughout its lifetime, you want to make sure that that is properly documented. And again, those should be original documents, okay? Or at the very least, certified and true copies, okay? Stamped, embossed, whatever by the county recorder of deeds. All right. So you need to have original documents. If the note seller does not have the original documents, that could affect the price that you pay because that could also impact your ability to be able to collect on the loan. All right. So the paper is very important. Right along in there with the paper is the payment history. Okay. It's good to have the payment history. It may not be a deal breaker to every investor, but payment history is very important because it's possible that a homeowner could maybe dispute the payment history. Okay. They may feel like they've paid more than what you're telling them that they owe. Okay. So payment history is also very important. And the lack of receiving a payment history could possibly impact the price that you're willing to pay for that mortgage note. Now, additionally, you want to look at whether the homeowner has ever filed bankruptcy or foreclosure. You want to determine whether or not they are currently in a bankruptcy. You want to determine if they are currently, if the first mortgage is currently in foreclosure with them. So that's very important. So you definitely want to factor that in as well. If the homeowner appears to be a serial bankruptcy filer, that could impact the amount that you're willing to pay for the mortgage. Okay. If they have been in and out of foreclosure over the last 10 years or so, that could possibly impact what you're willing to pay for the mortgage note as well. So these things are very key in helping you determine what price you should pay. So again, you want to start out by setting a baseline for yourself. And then from there, you want to kind of go up or down based on the characteristics of the loan. So the better quality of the mortgage in terms of the equity, the status of the first, the paper, the person, the homeowner, um, you're going to kind of go up or down based off of those characteristics. And so that should kind of put you in the ballpark of what that mortgage is going to be worth to you. All right. You may also factor in other things like whether or not the property is occupied or vacant, or if it's rented. Okay, so some investors prefer, self-included, prefer that the homeowner is actually living in the property, and that's their homestead. Other investors don't really care about that. They feel like, hey, it doesn't matter to me if it's vacant or if it's rented out, as long as the first is current, that means someone wants the property, and so it doesn't matter to me. So, but it may matter to you, and it may affect the price that you're willing to pay. So, to sum this up, there is no hard and fast way to determine how much you should pay for a mortgage note. You want to find out what the note seller's pricing expectation is. Do your due diligence on the note, the property, the paper, the person, and put all of that information together for yourself, and then determine, okay, based off of this is what I am willing to pay. And I would suggest having a range, okay, because that helps. All right. You want to have a range, and that'll kind of give you a little bit of room. But generally speaking, you want to kind of set a baseline percentage for yourself. And then from there, I would go, price up or down based off of the characteristics of the note. So, if you have any questions about this, please feel free to leave them in the comments. Also, visit notenewbie.com and take the free class. You'll see that in the upper right-hand corner. That'll also put you on my email list so that you can receive other information about distressed second mortgages. I also regularly will have a live training. So that'll put you on the list for the live training. So you'll get notifications for that as well. And yeah, so that's it. Thank you very much. Again, don't forget to like and subscribe, hit the notification bell, and I will see you in the next video. All right.